Hello and welcome to the CNBC-TV18 Mumbai newsroom. I'm Sonal Bhutra and joining me today is Ekta Batra. You're watching Mutual Fund Corner. Today we are going to be talking about liquid funds. They saw huge outflows in the month gone by, that is March. So what led to the outflows, and notwithstanding the outflows, is this a good time to invest in liquid funds? How do they stack up when compared to arbitrage or fixed deposits? We have a lot to discuss, Ekta, and we have just the right person for that.
Hi Sonal, yes, absolutely. So let's get going. We have with us Suresh Sadagopan, who is the founder at Ladder 7 Financial Advisories, to talk about liquid funds. Suresh, hi, welcome to the show. Well, I'm going to kick off the show by asking you about the big question in terms of what took place in the month of March when it came to liquid funds. We saw big outflow. Was it just an aberration, year-end adjustment? What, according to you, is the reason?
So these are temporary parking spaces, Ekta. So, liquid funds do go out when there is an outflow in terms of taxes or outflow in terms of GST payments and other outflows. So this is a standard thing which keeps happening every 3 months. I would say that the same thing has happened here. It's a year-end phenomenon. I don't think there's any particular thing to worry about. Especially considering that the tax treatment as far as the liquid funds, the shorter end, has not changed at all. For the viewers, things have changed as far as the tax dispensation is concerned, as far as debt funds are concerned. But in the case of liquid funds, nothing really has changed. So there is nothing to worry. On the contrary, as far as liquid funds are concerned, this is in fact an aberration. It is giving 6% or thereabouts today. And normally at the very short end, you don't get these kind of returns. Normally you get something like maybe 3.5-4% kind of returns in the case of liquid funds. Now you are getting a 6% or thereabout kind of return. If you actually look at the real short term, last couple of months or 3 months or something like that, the returns are even higher than that. So it's an aberration. I think people should take advantage of this situation.
So when you say people should take advantage of this situation, you mean it is a good time to look at liquid funds in that case?
So let me put this in context. As far as liquid funds are concerned, this is not exactly a investment product in the conventional sense. See, this is a short-term parking, either for maybe in the case of companies, maybe a tax outgo, or in terms of maybe short-term objectives or expenses which you may have, for which you are actually temporarily parking some money, or for some reason you want to invest at a particular point and you are keeping this as a temporary parking slot, you can use maybe liquid funds. So essentially liquid funds by its very nature is for temporary parking, and some people also use liquid funds if they want to systematically transfer money into equity funds over a period of time. They also put it in a liquid fund, and over a period of maybe 3 months, 6 months, they'll transfer it to even out the volatility in an equity market. So it's basically done for these kind of things. So from that point of view, as a temporary parking slot, it seems to be in a very, very good position, because even for the temporary period, 6% per annum kind of a return is actually a decent return if you were to look at it that way.
Okay, so it's more or less used as a temporary option. But Suresh, this is probably a question you get a lot. Is that the current spread between a savings bank interest vis-a-vis a liquid fund? What would you choose between the two options? Would you put your money in liquid funds, or would you recommend to your clients to put it in a savings bank interest?
So there are going to be two kinds of answers here. One is, if we were to look at the typical liquid fund, we are looking at a duration of maybe 1 month to 3 months, maximum 6 months. That is the duration of a typical liquid kind of a fund. Roughly about 3 months is what I would say the duration. If you are going to get a, say, 6% or thereabouts kind of a return in the case of a liquid fund, and if you want to compare that with a comparable tenure FD, so maybe 45 days, 60 days, 90 days kind of an FD, that's going to give you maybe 4.5% kind of return. And the tax treatment for a liquid fund and for bank FD is the same. It is treated as income, and you have to pay as per your tax slabs. So from that point of view, at least today, liquid funds seem to be scoring well. But having said that, there are going to be people who are quite comfortable, or purely from the point of view of, say, convenience, they would want to keep it in the temporary bank account or a sweep in FD. And at any given point, they may want to bring it to cash and use it for maybe expenses or maybe for investments or whatever purpose they have in mind. So from that point of view, for some people, a bank FD may be a good choice. But purely looked at it from the financial, maybe return point of view, at this point, I would say a liquid fund is a better choice.
Okay, at this point, considering whatever options you told us, liquid funds look like a better choice. Mr. Sadagopan, I wanted to understand what arbitrage funds would do in this case. First of all, can you explain that to us? And are the returns between liquid and such funds different? In what case should an investor go for either of them?
Yeah, I mean, you have touched upon a very, very good point, because that is also another choice which is available before the investor. An arbitrage fund is actually an equity-oriented fund where the difference between, basically it's options that we have, and basically arbitrage opportunities available between the cash market and the futures market. So basically, fund managers will play on that, and they will get a certain return based on that. So essentially, it will be the kind of return which one can get from the short-term debt product, which roughly at this point is maybe 4.5 to 6%. So currently, your arbitrage fund is also giving in that ballpark, 5.5 to 6% kind of a ballpark. It is giving. One very, very important thing which viewers need to understand is that arbitrage funds are treated as equity funds, though the risk profile is that of a debt fund. It's very low risk because typically it is a covered call that the fund managers do. That means the risk is extremely low, and you are still able to give 5.5 to 6%. And the icing on the cake is the tax advantage that you get because it is treated as an equity fund. In the case of an equity fund, beyond 1 year of investment, you pay only 10% after the first 1 lakh of capital gain. And in the first 1 year, if you happen to sell within the first 12 months, you tend to pay 15% as a tax, not as per your tax slab. So there is an advantage for people in the higher tax slab, 20% and 30% tax slabs. And for those people, probably at this point in time, arbitrage fund can even be a better choice as compared to a bank FD or a liquid fund.
Okay, all right. So in an arbitrage fund, what you're saying, Suresh, is that the return would still be around 5.5 to 6% It's a covered call, risk is low, though it is still an equity format in terms of investment. But Suresh, just wanted your thoughts in terms of what you would recommend between a fixed deposit versus a liquid fund. What do you think makes more sense?
So I think we have touched upon this earlier. So it's a personal choice, if you ask me. Purely from a financial standpoint, a liquid fund actually makes a lot of sense. I mean, for those people who are already investing in mutual funds, I think a liquid fund makes a lot of sense. But for some people, they do not want to now put money into a liquid fund. They are quite comfortable with their bank. They want to just deal with the bank, and at any point in time, they can bring it to cash if it is a bank FD or a flexi FD. So for such people, that may be a good choice. But purely from a financial standpoint, at this point, I would say for the short term, I think liquid fund actually makes a lot of sense.
Okay, we take your point. So it is liquid funds which are taking the hot seat today, of course, in comparison to the other investment avenues that there are. We'll do one thing, Mr. Sadagopan. We'll slip into a short break, and on the other side, we'll continue this discussion about liquid funds and a lot more. Stay tuned.
Welcome back to MF Corner. We still have with us Suresh Sadagopan, who is discussing liquid funds in details today. Suresh, the next question which I really had in terms of a discussion point was the net monthly flows for equity MFs, which is including arbitrage funds, declined 27% on a month-on-month basis. So arbitrage was the reason. What explains that?
If you actually look at the net equity flows in the month of March, it has actually gone up by 20,534. Arbitrage funds have, gone down to the extent of about 12,000 crores in this period. But again, just like we were discussing about the liquid funds earlier on, liquid funds is also a temporary parking slot for meeting certain needs and objectives. Similarly, arbitrage funds are also a temporary parking slot, which can go out for maybe paying the tax or GST, or for multiple other reasons it can actually flow out. So this is a temporary parking slot. I think we should not read too much into liquid fund going out or arbitrage fund going out. And one more thing is that arbitrage fund, while nominally it is combined with equity, I mean the underlying is equity. I do understand that, but truly speaking, if you actually look at the real risk in the product, and the nature of the product is more like a debt-oriented product in terms of the, especially in terms of the risk, it has very low risk. So from that point of view, I mean, we should not read too much into the arbitrage fund outflows, especially considering the temporary nature of this kind of a product. I mean, it being a parking slot.
Okay, so both liquid funds and arbitrage funds, they saw a massive outflow in the month of March, but nothing to worry about. It's a temporary phenomenon that we are seeing in both these categories. Now, the next important point is the pause that has come in with the RBI in the RBI interest rate hike that we saw in this month itself. Which segments really look ripe for investment? Debt has the negative impact due to the tax angle, but usually with interest rates coming down, Mr. Suresh, we do see that debt funds do well. So what really works in this scenario?
As far as what the RBI has kind of indicated, it is a pause at this point in time. I would venture to state that at this point in time, probably we are at the somewhere near the top of the interest rate cycle. You can never ever say that we are at the top, and you can never ever really time that. That is more so because today, because of the geopolitical situation, we are also connected with what is happening in multiple countries and their interest rate cycles as well, not just our inflation situation and our interest rate cycle. So from that point of view, we are somewhere near the top, and there is a possibility that once we reach the top, maybe in the next few months, it may stay there for some more time. That is a decision that RBI will take. So how long it will be at this particular point, we don't know. And when it will start again moving down is also slightly difficult to predict at every point, but more so at this point because of the geopolitical situation which is currently upon us. So that being the case, I will go with the hypothesis that we are somewhere near the top of the interest rate cycle. And if we are somewhere near the top, probably locking in onto say maybe a corporate bond fund or a dynamic bond fund, a medium to long-term fund, or even a target maturity fund, if you are really looking at investing for a particular tenure, these kind of funds will be good because when the interest rate cycle at some point in time, maybe a year or two later, when it starts going down, there will also be capital gains which will accrue from this. Till these times, till this particular point, these funds have been also showing a bit of capital losses. So the opposite will happen, and if you are well positioned in this from now on for the next 2-3 years, I think one will do quite well here.
Okay, just on that point, Suresh, with regards to the fact that maybe central banks have topped out in terms of hiking rates at this point in time, is there any incremental renewed interest or incremental interest, you'd rather have to say, within the equity fund space that, there is a bit of a risk on which could be possibly in store?
You are talking from the equity fund point of view in the context of the interest rate,
yes.
I mean, staying at a particular point?
Yes. That there's no further hikes which are possibly factored in for a longer period of time.
Yeah, and you're talking in terms of equity markets, right?
Yes.
Okay. So as far as equity markets are concerned, see, when the interest rates in the system starts going up, it is actually a negative for companies because in a very broad way, the cost of borrowing actually goes up. So equity, in that sense, you can say from that limited point of view, equity will not probably do well when the interest rates are very high in the system. So RBI will have to actually, walk that fine line in terms of controlling the inflation, for which interest rates need to go up, and also to ensure that there is a fair amount of growth in the economy and to support the industry. So it has to always walk that fine line. But what I would say at this point in time is, as far as equities are concerned, I think interest is not the real problem at this point in time, because equity is not only determined by the interest rate in the system. It is also determined by the demand cycle and various other factors. So, I mean, if you look at the other factors, interest rate is not really at a point where it is going to be deleterious for the industry. At least I don't think so. So from that point of view, while in a general sense, high interest rate is actually a problem for equities, I don't think at this point in time, the way currently it is poised, it is still very high. I mean, we have seen situations where it was much higher. So we are not really anywhere near where we have been in the past.
Okay. Now, since we are talking about equities and also talking after the massive meltdown we saw in IT names yesterday, what is your take on funds which are IT focused or sector funds? What should an investor's strategy be who are invested in those funds, or for someone who is a new investor, is it the right time to look at such sector funds?
See, as a financial advisor, we consider sectoral funds or thematic funds to be slightly more risky as compared to diversified equity funds. So whereas there are some people who are very gung-ho on a particular sector, maybe it is IT or banking or pharma or any other sector, and instead of taking a single company or a dual company exposure, it may be a far better idea to go for a sectoral fund. But having said that, a sector, I mean, sector is part of the overall economy, and there are maybe 20, 30 sectors of the economy which is represented in the overall equity universe. So looked at it that way, it's a small sliver of the overall economy, and we need to understand that we are actually taking a much higher risk if we invest in a particular sector over the diversified equity position. So looked at it that way, I mean, I would definitely advocate a diversified equity position as compared to sectoral funds. So I'll flip the argument around and say that if a particular sector is actually very good, the fund manager and their team will be able to also sense that and put appropriately higher amount of money in a diversified fund in that particular sector. So to that extent, I am not really a great advocate of sectoral or a theme, and I would leave that to the fund manager. And coming to the other question of what would be an ideal thing from a new investor point of view. From a new investor point of view, it's the diversified equity fund that I would advocate. It can be an active fund, good credible fund with a long-term track record, so which one can choose. I would in fact suggest a new investor to look at passive funds also, which have a large cap bias, maybe a Nifty 50 or a Nifty 100. Which, I mean, where the fund manager's skill in terms of choosing the appropriate equities does not come into play, and they can participate in the market. Or more to the point, if they really want to participate in the entire equity market, they could look at Nifty 500 kind of index funds, and they can directly participate in that. There is very little in terms of risk that they need to take in terms of the choices that they need to make, or the fund manager needs to make in terms of the equities that they pick. So I would very strongly suggest a new investor to look at passive investment over active investments. And once they dip their toe into the equity fund investing, then they can look at certain other segments like mid cap and large cap and maybe even thematic and sectoral at a later point in time. But to start with, I would suggest passives.
Okay, all right. So you would prefer diversified investing as compared to a sector-specific fund. But before we just wrap up this conversation, just wanted to circle back to liquid funds. Suresh, any recommendations within this space?
Yeah, if you look at the liquid fund universe, I mean, there are really short-term products, and I mean, if you really look at that, most of the available papers in the universe are, I mean, kind of similar. Okay, so to that extent, whether you choose fund A or fund B or fund C, there is not really too much difference. But I'm just going to rattle out a few names, and the viewers can, I mean, look at it. They can maybe confide with their advisors, and they can take their pick. They could look at funds like Aditya Birla Liquid Fund, or maybe a Nippon Liquid Fund, Axis Liquid Fund, maybe a Franklin India Liquid Fund. These kind of liquid funds. I've just mentioned 3-4 names. There are many other products which are there, which are credible and which one can invest in. This is really the short-term space. There is not much to choose one over the other.
Okay, all right. Mr. Sadagopan, thank you so much for joining us today and explaining to us all about liquid funds, comparing it with the other categories as well, and a take on the other side of things as well, with RBI pausing rates, at least for now. It was a pleasure speaking with you. Thank you so much for joining us. And with that, it's a wrap on this edition of Mutual Fund Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.